Welcome to the Explainer. Today, we're unpacking a seriously detailed analysis of Universal Corporation. We're going to find out if this company is literally the ultimate deep value dividend stock. It's an exploration into a market space that, honestly, a lot of folks just completely overlook. And the numbers we're going to look at, they are genuinely eye-opening. Let's get right into it.
Okay, so here's our roadmap for today. We're going to cover the misunderstood giant, the moat and the money, the secret ingredients pivot, why is it so cheap, risks and red flags, and then we'll wrap it up with the final investment verdict.
Before we even look at a single number, I want you to ask yourself a very direct question. Would you willingly invest in a sector that is facing undeniable, slow-moving secular decline? It's a massive psychological hurdle, right? Industry volumes are dropping by about 2 to 3% globally every single year. For most investors, that is an absolute immediate deal breaker. But as we're going to see, the surface-level narrative is kind of hiding a much deeper, much more complex financial reality.
Section 1. The misunderstood tobacco giant. The divide between perception and reality here is just stark. When you hear the phrase tobacco stock, you probably immediately picture a cigarette manufacturer dealing with massive litigation, direct consumer regulations, and advertising bans. But look at what Universal actually is. They are a 140-year-old business-to-business agricultural logistics middleman. They do not manufacture consumer products. And what that means is they are almost completely insulated from direct consumer-facing litigation.
And that brings us to their operational model, which is actually pretty simple but incredibly difficult to replicate. Step 1, they procure raw tobacco leaf from thousands of farmers all over the globe. Step 2, they process and cure it. And Step 3, they ship it off to the giant manufacturers you've actually heard of, like Philip Morris. So they operate this incredibly durable middleman model with zero disruptive technology risk at the supply chain level. I mean, they've spent over a century building a massive global network that would cost billions to try and recreate today.
All right, Section 2, the moat and the money.
Take a look at that massive 53 right there. That number represents Universal's unbroken consecutive dividend growth streak. Just think about everything that has happened in the global economy over the last half-century. We're talking oil shocks, massive financial crises, a global pandemic, huge shifts in consumer habits, and through all of that, management has shown the absolute discipline to not just pay a dividend, but to actually grow it year after year. That is wild.
So the real question is, how do they actually afford that growing dividend? Well, it comes down to this 18.5% figure. That is their free cash flow yield based on fiscal year 2025 numbers. They generated $268 million in free cash flow. That is a seriously high yield, and it effortlessly funds their generous 6.2% dividend yield, leaving plenty of room to spare. This right here, this is the financial engine of the whole company.
Now, to really figure out if this stock is actually cheap, we need to apply legendary investor Peter Lynch's favorite metric, the P/E-Y ratio. You see, traditional price-to-earnings ratios can be pretty misleading when you're dealing with high-yield stocks. So Lynch designed the PGY to adjust traditional PE for both the combined earnings growth and the dividend yield. It basically just gives us a much clearer picture of your total shareholder return.
And when we run Universal's numbers through that exact formula, we get 0.87. Now, in Peter Lynch's framework, anything below a 1.0 is a classic buy signal. It mathematically indicates that the stock is pricing in way more pessimism than the company's combined earnings growth and that massive dividend yield actually justify.
Let's move on to Section 3, the secret ingredients pivot.
Looking ahead over the next 5 to 10 years, check out the blue slice on this chart. Universal is taking its century of global agricultural sourcing expertise and applying it to a brand new, ESG-friendly ingredients segment. We're talking stuff like fruit and vegetable extracts, botanical distillates, nutraceuticals. The source analysis projects that this specific segment could soon make up 20 to 25% of their total operating income.
The big takeaway here is the absolute strategic brilliance of this setup. They have a shrinking but incredibly profitable core business in their legacy tobacco operations, right? And that massive cash flow is actively financing a very credible long-term diversification story in the food and beverage space. It's essentially like getting a free call option on a totally new, massive addressable market.
Section 4. Why is it so cheap?
The source material explains this as a pretty straightforward market mechanic. It all comes down to ESG. Environmental, social, and government screening. Basically, institutional investors and massive pension funds are being forced to systematically liquidate any tobacco-linked holdings. And what does that do? It creates a severe, indiscriminate seller-driven discount.
For retail value investors who aren't bound by those strict institutional screens, this forced selling is exactly what creates such a huge mispricing opportunity.
All right, Section 5, Risks and Red Flags.
Okay, we've got to look at the downsides. The most obvious threat here is the secular volume decline of 2 to 3% annually in the global tobacco market. But structurally, you also have a rising debt-to-equity ratio, which has crept up to around 71%. On top of that, the company recently appointed a new CFO, and they actually had a late 10Q SEC filing because of an internal investigation. Now, that filing issue was eventually resolved without any restatements, but these factors, especially that rising debt load in a shrinking core market, they absolutely warrant some very close ongoing monitoring.
And that brings us to the ultimate indicator of fundamental deterioration. It's probably not going to be some dramatic headline or a sudden industry ban. The real canary in the coal mine will be the dividend payout ratio. If that impressive 53-year streak is ever broken, or if the free cash flow suddenly stops comfortably covering the payout, well, the whole thesis breaks. That makes it literally the single most vital metric you need to watch quarter after quarter.
And finally, Section 6, the final investment verdict.
This nicely lays out the 3 potential futures for Universal. Let's just focus on the base scenario right in the middle. If we assume standard 2 to 3% volume declines that get offset by their pricing power, and we assume they maintain that dividend, the intrinsic value sits somewhere between $63 and $70. Now, with the stock currently trading right around $58, we are sitting just below that base fair value, projecting a really solid 9 to 11% annual return.
This is where you can really see how the dividend does the heavy lifting. Just look at the column on the far right. Let's say you're a strict value investor, demanding a 9% return over 16 years. Well, your required entry price, when you factor in reinvested dividends, is approximately $43. So that makes the current $58 price essentially a conditional buy. But it clearly signals that this stock becomes a screaming strong buy on any significant market dips. Looking at this through the lens of the late legendary investor Charlie Munger, the source material classifies Universal Corporation not exactly as a wonderful business, but rather as a fair business at a fair price. It totally acknowledges the slow growth headwinds, but it also deeply respects the century-old franchise, that near irreplaceable supply chain, and the incredibly generous income floor it provides to investors.
So, I'll leave you with this final thought to consider for your own portfolio. Does the massive cash generation of this misunderstood monster, an 18.5% free cash flow yield and a half-century of growing dividends, does that outweigh the undeniable slow-moving secular risks? It is the classic value investor's dilemma. Thank you so much for joining me for this explainer, and I really hope this structured dive has given you a clear, objective framework to answer that exact question for yourself.